What's up, everybody? It's a pretty good day in the market on Monday, the last day of the first half of 2025. Apple crushed it, 205.17. It went up like 2% today. Amazon, 219.39. Amazon went down today. Let's see it. Berkshire, 485.77. That pretty much stayed flat. CVS, one of the best stocks for 2025. That's at 69. How did gold do today? 30. Gold went up quite a bit, 1.5%. Google went down, right? 176.20. Yeah, went down a little bit. Let's see, Lyft, 15.76. So flat for the day. Meta went down. I kind of recall 738. No, it went up. But it went down today. How did Microsoft do today? 497.41, went up a little bit. Netflix, $1,300 a share. They're going to split. That went up as well. Nvidia, I know Nvidia went down. 157.99. It barely went down a penny from Friday's close. Yeah, I manually update this Excel file. I know it's a waste of time. I can have a plugin, but I like to see it. I like to see it change. I remember it a lot better than having everything automated. I do have the Yahoo app. Permabull, what's up? Tesla went down a lot. How did Uber do? Uber went up. So, this formula I deleted this formula. Let me. Okay, good. It's right here. I thought I deleted the formula by mistake. So there's this formula. It's an if statement, but nested in the if statement is a min and max statement. And what it does is it looks on all the entire row 6, which is the percent change of the stocks, and it identifies what did the best, which is CVS, which that went up 36% for the first half of 2025. And what did the worst? That's Tesla, went down 19%. Yesterday, when I was doing this, when I was looking at this chart, Apple was the worst. But today, Apple went up 2%, Tesla went down. So that's why Tesla did the worst the first half of the year. So hope you guys, life is good. Wishing you the same. Thanks. So I did see a blurb about default rates on 30 to 59-day loans went up, which is a big deal. Home, residential, default rates. Let's see if I get a little more. Did anybody see that in the news today? So all these articles are really old. It's hard to find mortgage default rates. Okay, maybe this website's updated in real time. FHA versus VA. VA is Veterans Administration. FHA is Federal Home Administration. Generally, people who do FHA loans are lower income. People who go through banks, on average, have higher income than people who do government loans. FHA is like a loan backed by the government. They provide a lot of liquidity to market because they have standard terms. So when people go to them, they don't have to be worried that they're gonna get like scammed out of like any money or things like that. They have like fixed terms. So if your FICO is this number, your income is this number, the value of your home is this number, then your rate will be X percent. Where if you go to like Chase, the mortgage broker is going to be kind of trying to like get you to buy down points or all these things or get you into different loans. But even though it's a government backed loan, it's pretty inefficient. I know it's a mess there. They don't keep good records. So FHA loans, they offer a low down payment requirement. So that's the hardest part of getting a loan, the down payment. A lot of people can't come up with the $50,000-$60,000. A lot of people can afford to pay the monthly mortgage rate. Like most people are paying the same amount of money they would pay in a mortgage. Like if you're paying $2,500 a month for rent, it's pretty likely you could find a mortgage that costs $2,500 a month. But the rub is coming up with, if it's a $250,000 loan, you need 20% down, right? And that's $50,000. A lot of people don't have $50,000 to get the loan. They have $2,500 because they're paying it each month. Now, what you could do is you get PMI, private mortgage insurance, and then instead of putting down 50,000, you could put down 25,000. You could put down half, and then the PMI is the insurance that protects the lender, protects the bank in case you default. But here's the default rates for FHA loans. So they were, the DQ rates. So they peaked in 2004. They were actually coming down from 2004 to 2007, and they got pretty low in 2010 because it was hard to get a mortgage after the subprime crisis, and the only people getting mortgages were people who had plenty of liquidity. But as lending gets a little more loose, banks are giving more loans, the government's giving more loans, delinquency rates go up. So now we're not even close to, this is VA loans. I don't see how it could be negative, the default rate. It's negative 200, but I'm sure but VA loans have really low default rates, only 4% in the subprime crisis. Well, subprime was like 2004 to 2008. It was 8% for FHA loans. And FHA loans actually peaked in COVID. Big Gus, what's up? Defaults peaked during COVID. 1,000 basis points. That's 10% of loans defaulted. It was higher than during the subprime crisis. But the problem with the subprime crisis was not so much the defaults. It was the derivatives, the CDOs. So it had like a trickle down effect where these loans, like you could have had a loan. It was part of this securitization. They call them CDOs or CDS, credit default swap, credit default obligation. So a pool of loans would be in these investment vehicles. I actually did this on Wall Street. I underwrote a lot of these deals at JP Morgan in 2000, 2005. Then I worked in the insurance part of things. So they would take like all these garbage loans and put them into these swaps. And they structured it in a way where it appeared that it was very safe. Meanwhile, because they would pitch it to you where the only way the bond would default is if interest rates hit 20%. That's the only way, and that's when the triple, maybe the double B bond defaults, the lowest, because there'll be several bonds in these structures. You have so triple B is investment grade. So if you have triple B or above, you're considered investment grade. Double B below triple B is below investment grade, and when we sold these bonds in the market, you would offer, say, 4% interest rate on the AAA. And then it'd be 4.5% on the AA, 5% on the single A, 5.5% on the triple B, and then 6% on the double B. Because the worse the bond, the more likely of default, the higher the interest rate you should receive because you're taking on greater risk. So this would be like a $10 billion bond. Like the AAA, we'd offer $10 billion of AAA bonds. That would be the most. And then double A would be like 2 billion. Single A would be 1 billion. Triple B would be 1 billion. Double B would be 1 billion. Let me just change the formatting. It's easier to see. Okay. So this particular vehicle, we call them SPVs, special purpose vehicles. It's just, it like jumps. I don't understand. It would be a $15 billion portfolio. It's actually, we'd have like massive ones. Like we had some like 100 billion, 200 billion. But so how they would pitch it to us is that they would say, the only way it would you'd have to pay any claims. The insurance company would have to pay any claims is um, if default rates hit 20%. That's the only way. And in history, we've never had 20% residential default rates. The highest ever been was like 16%, and that was during 1980 something. And the double B would get hit first. They take the first loss. So unless you had $1 billion of loans that defaulted, that's the only way triple B would get hit, because after $1 billion of losses, then the next homeowner that defaults, the double B bond gets hit. They take the loss, and they say it would have to be like 28%. Did the screen just change on you? What's going on? So weird. Okay. They're like it would have to be 25%, and the only way for double A to single A would be 30%, and then 35% for double A and 40%. And they were like, it's never happened. There's no chance the triple A would ever get hit. And defaults, some of them got over 50%, because it was all junk in these all or garbage loans. And I've seen some deals with 60% defaults, because it's not unique. Because if your neighbor defaults on their mortgage because he didn't have enough money saved up, or maybe he needed surgery and his medical bills turned out to be really high, it's not going to affect you. It's not like because your neighbor defaults, then the rest of the block defaults. It's kind of unique to him. It's not like if he needs surgery, then other people need surgery. So that's a unique situation. But the problem was, it was all connected, because all these loans, the mortgage loan, they started adjusting. So everybody who's paying, like, you were paying $2,500 a month, and then after like 3 years, the rate would adjust, and then you'd pay $3,500 a month. But the underwriter said it's not going to happen, because in 3 years you just refinance, because the value of your home goes up every single year. So even if you do get to 3 years, you just refinance it and you go back to $2,500. But the problem was the value of the homes went down, which was never part of the equation. They never said, what if home values decreased? And they decreased dramatically, and that's what happened. That's pretty much the how the subprime crisis came about. Why did I talk about that? Oh, we were talking about default rates. Okay. Yeah, I'm really surprised default rates in 2021 were higher, or 2020. But they've come down, but they're still pretty high. They're at 2007 levels. But like I said, the problem wasn't really defaults. Of course, defaults affect. The problem was the way the loans were structured. It was structured in a way where the value of your home had to go up in order for things to work. If the value of your home went down, then you couldn't refinance. You didn't have any equity in your home, and that's how default rates started, like, ballooning all over the place, because people couldn't afford a higher payment, or they just couldn't afford the payment anymore, and they were banking on refinancing or taking money out of your home, taking like $100,000 on a home equity loan just to pay your bills. And that couldn't happen because if you were this person, $250,000, and a lot of people weren't even putting much down. But let's say you put 10% down, so you put 25,000 down. So your principal is 225,000. So if in 3 years your home is worth $350,000, and even if you lose your job, or even if you can't afford your mortgage anymore, or if your monthly mortgage is going up, you have 125,000 of equity, which is pretty good. So you can just take, $60,000-$70,000 home equity loan, and that'll kind of hold you over until things get better. But the problem is the house values didn't go up; they went down. And even if they stayed the same, even if it stayed at $250,000, you can't refinance anyway because of all the fees and things like that. If there's only 25,000 of equity, you would need to have an LTV at least like 70%. So LTV, loan to value. So if your loan was, and how does it do this? Understand? Okay, so if your loan was $225,000 in our example, and the value of the home is $250,000, LTV is 90%. So it's a pretty high LTV. You're probably not going to be able to well, you definitely can't refinance. Now, the loan is not going to probably go up unless you have a reverse mortgage. But let's just say it's going to go down, the loan, because you pay principal. So it might go down a little bit, and you might pay more principal some months. So maybe you knocked off 10,000 on principal. So now the loan is down to 202,000 after like 5 years. You kind of need an LTV at least 70% to get a loan, to get a home equity loan, a second line of credit. So you need the value of the home to be at least 289,000. And if it's not, you're not going to be able to get a loan because it's just too risky for the bank. But what do you guys think? Is there anything going on today? Anything else? So top game, Bitmine immersion went up 700%. I saw Master went up, but Bitcoin went down. So I didn't understand that. Master, they buy Bitcoin using convertible debt. That went up 5% today. So I assume Bitcoin went up a lot, but it didn't. Didn't Bitcoin go down? Yeah, Bitcoin went down 1.3%. What are your thoughts on CRM? Yeah, Salesforce. I like Salesforce. 273. $261 billion. Yeah, it's the largest company in its industry. You do get a dividend. 0.6. 0.6%. Let's see what the future free cash flows are going to be. First, let's value it, and then we'll look at the historical price. The free cash flows look real good, and the forecast is pretty strong, 13, 15, 17. Yes, I'm close to $400. I mean, they generate a lot of free cash flow, as you can see. And the forecast is 17 billion by 2028. Let's see Simply Wall Street, where are they at? I think this row is not doing anything. A lot of people are down on it, but they are a cash machine. Simply Wall Street's at 350. So a little less than me. This is really slow today. I don't know why it's so slow. So you can see they started trading in 2004, and when you adjust for stock splits, $4. So you could have 60x your money, 6,000%. And it pretty much only went up until COVID. It went pretty much in a straight line to 180. And then during COVID, can you see it here? It came down to like 110 during the COVID bottom. And most stocks hit their all-time highs. Did it hit its all-time high? Yeah, hit its all-time high, like most stocks, at the end of 2021, almost $300. And then there was a big sell-off. That's just how it is. The higher a stock gets, the worse of a value it is. And the lower stock gets, the better of a value it is. So the higher it gets, the more likely people are going to sell, because people have their sell orders set. Sometimes they have them set from a year ago. Like they say, if like they buy to 200 and they have a sell order for 250 to sell half their shares at 250. And once it hits 250, even if it's a few months later, it sells. And people have sell orders at 300. Same thing with buy. People have buy orders. And then there's people, of course, like us who watch the stock every day. So we don't need to put those orders in. But once we see it hits our price point, then we buy it or sell it. But there was, after the peak, I mean, it's just inevitable when the market peaks, then 2022 was a rough year, a very bearish year. It was terrible. I think Meta got down to like $89. So it went from 300 down to 130. A really good time to pick it up. But you can see, like with any stock, there's resistance points. So that's kind of 130 is kind of like the resistance point. You can see it doesn't really get below that, because a stock could only get so low, because the lower stock gets, like if this got down to like 100, it went from like 250 to 200 to 151. some people are going to lose a ton of money, but the people who don't lose money are going to start jumping in. If it gets too low, it just can't get that low. A company that generates cash flow like this, if it's a company that's losing money, it could get really low. But it's a company like this just can't. So that's the resistance point, about 130. And then it has a new high at 315. That was in March 2024. So that's kind of like the barrier, you could think, 130 to 315. And that's a resistance point. And you can see from 2021 to 2024, so that was 4 years, it stayed in that range. And it finally did break the 330 resistance at the end of 2024. A new high, 370. So it's going to test that high at some point. And if I knew when, of course, I'd be a billionaire and I would be day trading. But I don't know when it's going to get back to. I know it will. I don't know if it's going to be this quarter or in 3 years. But yeah, that 370 is new resistance point. And it's possible the new low, the new bottom resistance point is 236. We won't know until a few years from now as the stock trades. But there's definitely downside potential. There's a lot more downside potential than upside potential with this stock. In the long term, it's going to go up. I just don't know exactly. So is 270? I mean, based on my valuation, it's a good deal. Of course, well, you couldn't have got it really for lower than 270. I mean, even in 2024, there was only like maybe 2-3 months it traded below 270. It's pretty much been trading for most of the time. In 2023, you could have got a great deal on the stock, but in pretty much all of 2024, it probably averaged like $300 a share or $320 a share. And in 2025, so will it test the new low? I don't know. It seems like it's a pretty nice discount. Because what, 362, 368, 368, and what's it trading at now? Well, it's on my sheet, right? $368, and it's trading $273. So it's trading 26% below its all-time high. So you're getting that gap. That's your profit. Of course, it can easily break an all-time high, but at a minimum, I think you have 26% upside. And I'm sure it's going to break its all-time high. But generally, it's not bad to buy a stock at its all-time high. Like if you bought Nvidia today, I can't say it's a bad investment, because if you bought Nvidia 3 years ago and it was trading at $1 trillion market cap at its all-time high, at that time you would have said, "Oh, I want to wait for it to pull back," but instead the stock quadruples. So I'm a long-term investor. I picked up some at 180. Yeah, I'm a long-term investor too, so I do prefer not buying things at their peak, as anybody should. But if I'm scared it's going to keep running up, then I bought Google at its all-time high, and it was down 25%, pretty much right away. And it took 2 years to get back up to where I was. But now I'm up 50% on my Google. So, and I bought Meta at its all-time high at different points. Yeah, Google in February 2022. I got it at 146 right before the split. So I thought in February 2022, you see, I got it right here. So it wasn't actually at its all-time high. I thought it was. Oh no, wait, I'm on the wrong. Okay, here's February 2022. Okay. So I bought it right here. So actually, no, I thought I bought it at its all-time high, 146. Yeah, it's pretty much because it was like maybe 2% below its all-time high. Its all-time high when I bought it was like 150. So you can see it ran up a lot, and I got it around here right before the split, and look how much I was down. I was down like 50%. So when I bought it in February 2022, I had to wait a little over 2 years just to get back to where I was. But I think of Google as just a stock that's you can always keep. You don't have to like, watch it every day and sell if there's bad news. That's just a stock that's going to go up over time. So I wasn't really concerned. Because if you bought it like around here, you can't even tell the ups and downs. Like you might have bought it in 2007 at 17 and you had to wait like 3-4 years to get back up to where you are. But you can't even tell. That's how much it went up in the last decade or the last 6 years that you can't even tell if it was a good investment or not down here because it's almost a flat line. Yeah, dollar cost average. Yeah, that's a good idea. The problem is that when the market goes down, like remember when Meta hit 89? Of course, now we think, oh my God, I should have just, put all my money into it. But when your stocks are down like 30, 40%, because that was when you don't have like all extra money. You don't want to like sell your stocks at a loss to buy another stock that you're already losing a ton of money on. That's a problem when the market goes down. You just don't have money to invest. And when the market goes up, you don't want to sell a lot of stock because you're doing well on it. And people generally don't want to sell stock when they're up a lot because they feel like it's winning for me. So it could go higher. Yes, when the stocks are down, I'll go into my reserve. People generally do the opposite. When the stocks go down, then they want to sell it, or they just exit the market because they can't handle. But I tell them this is the best time to buy. Don't sell. This is when you want to buy. And sometimes they listen, but they wait a year and they go, I'm still down a lot. You know what you're talking about? I go, well, a year is not enough. Like if you look at the S&P 500, like my friend, her father died in 2019 or 2018, and left her like 50,000. So she put into S&P 500, and she was up like after a year like 25%, then like 30% at the best. So she was happy about investing in the stock market. And then it went down. Then she was down like almost 50%. So she just sold out. She's like, can't handle this. This is and that was the fastest crash. If you would have just waited 2 weeks, it would have came right back. And then it would have she would have tripled her investment. She came in at 300. So she would have pretty much doubled by now. They just don't know. They don't understand it. They think if it goes down, it just could keep going down. And they don't realize it's not like an independent event, a stock, where like if you go to a casino and play a slot machine, it's independent. anybody could win the jackpot. There's no like information. But with the stock market, it's connected to businesses. There's a lot of information. So what was the oh yeah, so the S&P is over 6,000. Simply Wall Street at 7,000. Will it hit 7,000? I think we're going to be in a bull run for a long time. It's all indications that the market's going to continue rising because AI is a big reason. All this innovation with AI is reducing a lot of jobs, which makes companies more profitable. But it also creates a lot of jobs. But it's all about profitability of companies. That's how you make money. And jobs are extremely important. But it's not like, especially in the US, we're not at a shortage of jobs. A lot of the jobs, the simple jobs, aren't able to get filled in the US. A lot of jobs where people do a simple task, that's a difficulty of filling those jobs. So a lot of those jobs are going overseas. Keep an eye out for Anduril Holdings going public. What are the stocks you guys looking at that could 5x, 10x, double? Let's see what did well today. This BitMine went up 700%, but I don't think that actually went up 700. I think that they probably just did a stock split or a reverse stock split. BitMine immersion, but you can't really go up. I mean, you can go up like 87%, but when you go up like a nice round number, like 700%, I mean, it's not perfectly 700%, but it's pretty close. That indicates they did a 7-for-1 stock split. BitMine immersion. Okay, you see that it was well, this makes sense. 8-for-1 reverse stock split. Is this the same company? Huh. That's funny. That happened to be an article about an 8-for-1 reverse stock split, which what I was expecting to see. Okay. So BitMine, BMNR. Is that this? Yeah, BMNR. Skyrockets over 500% in a single day rally. So maybe it was the jaw-dropping surge has turned BMNR into the talk of Wall Street as traders and investors scramble to understand the catalyst behind the message. BNR chart. Well, today overwhelmingly positive. The full picture. 5-day performance, a gain of 500%. So it's just a really volatile stock. I guess it really did go up. Wow. Yeah, it did go up. But you can see like it's down like 99.99% from its peak. Even in the past 5 years, it's down almost 100%. You can see it peaked at 600. It's down in the past 3 years a little bit, but it's probably up in the past year. Okay, in the past year, it went from 11 And before the surge, it was $4. And just today, it went from 4 to 34. But it's going to go right back down. It's not like it's fundamentals driving it. It's just stock movement. Like but yeah, it's a waste of time to talk about these stocks. Let's look for real companies. Big Bear AI is up 16% today. EOS Energy 16%. Robinhood up 13%. The online trading platform. Hewlett Packard, they must have reported earnings to be up 11%. Quantum Computing 11%. Webull, another trading platform. Sunrun, it's a terrible company. SoundHound 9%. Let's see the biggest losers. Fortive, that's a pretty big company. That went down 27%. I'm not too familiar with most of these companies. Next Tracker, I think I did a video on them. So why did Fortive go down so much? Fortive stock lower. Oh, they spun off a part of the company. So a spinoff means you it's like a divestment. You're not selling. You're kind of just shifting a part of the business. So say you have two segments, like retail real estate and wholesale real estate. And you might have 100 billion in retail and 30 billion in wholesale. And the market cap for your whole company is, say, like 20 billion. The whole company's worth 20 billion. And within the company, you have the retail and wholesale segments that contribute to this 20 billion. But if you spun off your wholesale segment, say the ticker is REW, which is just call it RW, retail wholesale. RWRE, retail wholesale real estate. And it's a 20 billion market cap. But say you spun off the wholesale division. So the retail division would just keep the ticker. You don't change both tickers. And then people can buy just stock in the wholesale division. So this $30 billion of revenue would only go towards this ticker. And market cap may be 15 billion because it's just the retail division now, and 5 billion for the wholesale. So it'd still be 20 billion. So if you own stock in the company last week, say you had $1,000 of stock in ticker RWRE. Now you would own stock in both companies. You would still, the total would still be 1,000. But your shares would be split between two companies. Some companies do this because it's easier sometimes to just focus on one product. All your resources in your company go towards one area rather than splitting it. Because if you think about it, like some positions there's only one of. Like there's only one CEO. And in this company, that CEO is spending time working with managers in the retail real estate division, wholesale real estate division. So he's splitting his time. He might spend more time in one division than others. And they'll be like, say an accountant, say there's 10 accountants and 7 work on the retail real estate side and 3 work on wholesale. In a new company, this company, the just the retail division would have 7 accountants, 7 employees, and maybe it would be in a different location possibly. And this company, this ticker would have 3 accountants. It's just easy to like focus on a particular product, especially if one is growing a lot more than another. It's better to just kind of like separate them. So yeah, so they spun off one of their divisions and then the market just didn't like it. That can happen. Even though there's no change, they're just kind of splitting things up. Sometimes people don't like it. Because you do have to, I mean, the one position you have to have another one of is CEO. You also have to have a CEO in each company now that you split them up. Before there was one CFO as well. But there's probably a lot of vice presidents and a lot most positions there's a lot of those positions. So there's probably crossover with some positions. But okay, Fortive dropped 2%. This is an old article. No, it's 630. 2% following the completion of its Precision Technologies segment spinoff and a warning about second quarter revenue pressure. So that's the reason it went down. They mentioned revenue might be lower than expected. The company announced that it's finalized 100% spinoff of Raylant Corporation shareholders, Raylant beginning regular way trading on the New York Stock Exchange. So if you owned Fortive, ticker FTV, now you'll own shares in FTV and RAL. Of course, you can sell shares in either at any time. And they mentioned who's going to be the president. So Ola Mundi has assumed the role of president and CEO, succeeding James Lico, who has retired. So the significant stock decline appears driven by Fortive's revelation of unexpected headwinds. Because that's the main reason. They're saying there's going to be downward pressure, headwinds, as they call it, on revenue. The company disclosed that increased pressure on tariff-related pricing and customer demand driven largely by heightened uncertainty in trade, healthcare, and government. Okay. Well, this is not too popular of a stock. I don't think so. WIMI. I remember doing it. Well, it's only 12 million market cap. That went down a lot. I remember that's one of the first videos I had that blew up because I predicted it would go up like 600%, and it did, or it beat it, and it got a lot of views, that video. Wow, it really came down. It's down 95%. So you can see it was 51. Let me see if I can find the video. WIMI in June 2020. I started the channel in May 2020. So it was $3.40. But the problem was it looks like they did a reverse stock split, so it looks like it was $40 in 2020. Like I did a video like when it was a brand new stock, when it was down here, and then it tripled. So it was 340 in 2020. When you do a reverse stock split, it appears they did. It looks like they did a 10-for-1 reverse stock split sometime around here, and that makes this look higher. But I predicted, yeah, I predicted stock would go from 340 to 826, so more than double, and it did. It pretty much hit what I said. A little more than doubled. But I mean, it's not the only reason it went up is because Jack Ma, the CEO of Alibaba, he did a presentation using WIMI hologram. Like there was it looked like Jack Ma was there speaking, but it was using their technology, and it was him speaking the. Let me see. Yeah. So stock went up a ton. See, Jack Ma's holographic appearance in July 2020. Jack Ma of Alibaba appeared at the World Artificial Intelligence Conference as a holographic projection because that was due to COVID-19. So it looked like he was presenting at an AI conference. He wasn't actually there, but WIMI made it look like he was there. You can see right here. Incredible analysis. It's because of you that I had so much confidence to buy this morning at 7, even though it was up 100%. I hope he sold because it came right back down. This could be having a day in the sun now. It looks like the volume is way up. For analysis, one thing. Can you do an update? Buy WIMI at 11. I think your video will have many views from today. People always asking for the Excel file. $3,600 views. Only 3,600 views for a video that predicted the stock price. You find videos with millions of views and they don't give any information, any helpful information. It's all just noise. So that's YouTube. Any other stocks? What are you guys thinking? Any other big movers today? Yeah, Robinhood did really well today. What the heat map? That's a good thing, right? The heat map. That's a fun thing to look at. Now, Apple crushed it up 2%. So I guess Nvidia is still number one. Uh, Obviously, has to be number one. 3.85 trillion. A little ahead of Microsoft. They're only maybe 5% ahead. A lot ahead of Apple because Apple's really come down a lot this 2025. Amazon's getting up there. You would think Google with Waymo, SoFi would be. I think now that Tesla is now finally tested a robotaxi and has it out in the market, and hopefully they'll start scaling Tesla because it's going to help Waymo because it's a huge market. Robotaxis. It's not just people who need rides, taxi rides. A lot of people will use use it as their car, or autonomous car, and a more comfort. If you use a robotaxi a lot, and you were a little hesitant up on an autonomous car, you're going to be a lot more comfortable after you use a robotaxi a bunch of times, and you'll see how safe it is. Much safer than driving yourself. SoFi. So let's take a look at the heat map. So Amazon down 2%. Nvidia ended up going up a little bit. Google's down. Meta's up. Dan Palantir. Tesla's down. Tesla had a bad first half. What stock is that? Goldman Sachs, 2.5%. That's pretty good. Nubank went up a lot, like 4% today, and Nubank is similar to SoFi. They're both fintechs. So 19 billion, still a pretty small market cap. Nubank is bigger than 19 billion. Nubank is like 60 billion. So I always wonder why SoFi is not doing as well as Nubank, because they pretty much do the same thing. I mean, look at that. It still has a pretty high price multiple, 40. You would think it'd be lower. The price sales 7. The revenue looks like it's projected to do well. Free cash flow, they're projecting positive free cash flow. Because you would think an online bank is going to replace a lot of the banking industry. And I mean, I thought they were one of the biggest online banks. Let's see the insiders. What are they doing? Okay, a couple of sales. Really big sell, 31 million shares, Silver Lake Technology. Is that the company, the SPAC that acquired them? It probably is. Silver Lake, they led the one of the funding rounds. So they invested 500 million in 2017. I think they probably lost money. So they invested in 2017. So pre-IPO. So I don't know what they, how much they paid. I know how much they paid. I don't know how much per share, like what they got for that. I'm sure they made money, but I mean, it's not like it's done that well. The peak was right when it IPO'd. It's never gotten that high again. I mean, it was trading pretty low at some points, 443 in 2022. But it seemed like it should be going up a lot. Do you own this stock? It's like Palantir is similar. I feel like they're kind of like, I know they do different things, but they both reminded me of like meme stocks. So only half the shares are owned by institutions. Employees are going up. That's a good sign. I think SoFi was a SPAC. I'm pretty sure. Yeah, SPAC. So that means it was private and got acquired by a public company. So the Qatar Investment Authority was a big investor. They signed a 20-year deal with the LA Rams and the LA Chargers. So they sponsor the stadium, SoFi stadiums. 1260. It's pretty good. I'm sure you wish it was higher, but I think that's a good price point. Did you get it this year at 1260? Because you could have got it this year at 1260. You could have got it in 2024 at 1260. Probably you got it this year, right? Because if you bought it in 2024, you probably would have sold it by now because it's really done nothing. It is finally breaking out. It's still trading 18, 20 to 25% below its all-time high. So there seems like a good amount of upside potential. But yeah, I just don't get it why it's, well, let's see. Okay, fintech banks, largest fintech banks. See, they list regular banks because I mean, if you really think about it, every company, every bank's a fintech bank. Every company is an internet company because pretty much every company does a lot of business on the web. Like I know Walmart is a brick and mortar retailer, but they do a lot of business online. It's probably like 10%. Every company is an internet company in a sense. Online sales 18%. That's a pretty big chunk of their business. It's not like it's under 1%. Because you wouldn't call those glasses, those AI glasses, what do they call it? What's the name? There was a Meta. Um, they have a division at AI products. What's the name of that Meta product they sell on? How come it's not coming up? Um, I thought they were glasses. No, it's not glasses. It's a what's the name of it's one of their divisions. Um, where's the SEC file? Oh, oh. Come Reality Labs. That's what I was thinking of. So you wouldn't say, oh, they're a reality lab company because $400 million of revenue is from that product. You know, you would say they're an online advertising company because that's 99% of their revenue. Because companies do so many different things. Like you wouldn't call Walmart an e-commerce company. You would call Amazon an e-commerce company, but Amazon gets a lot of revenue from non-e-commerce sources. But you have to call them something, and generally it's what they make. Quest? They're not a Quest company. Yeah, so that is a lot of revenue. So what was it? 26% of Walmart's revenue is online. So when I type in the largest fintechs, the first one is Visa. Visa is not a fintech. Of course, every bank does online banking. So every bank, in a sense, is like a fintech. But when you say fintech, you're talking about a pure play fintech company like Nubank or SoFi. I just want to make sure I'm using it right. Yeah. Fintechs include PayPal and Square for digital payments, Robinhood for investments, Stripe for online payments. I wouldn't consider Robinhood a fintech. Of course, they use financial technology to do their business, but I consider them an online broker. But anyways, pure play fintechs. I'm still not going to get a good answer. It's going to be the same, trying to sift through what is a pure play. That's just what is a pure play. It has nothing to do with fintechs. So I'm not going to be able to find the answer, but I could just sift through the noise, figure it out. Let's go back to this thing. So they list Visa as number one when I type in largest fintechs. Tencent, the Chinese game maker, is number 2. So I wouldn't say these are SoFi's competitors. Maybe Visa a little bit. Not Intuit. Stripe very little. Fiserv, these are just payment processors, which every bank does. I would consider Nubank similar to SoFi. So I'm looking to see what are there other American banks besides SoFi. I want to see who their competitors are because I want to get an idea of why they're so small. Because if you look, Nubank, which is a Brazilian company, their market cap is 64 billion. And then SoFi is only 19 billion. Ally Financial, they're not really a pure play fintech, but that's another example. 12 billion. Because Ally Financial, are they pure play fintech? Ally Financial is an online only and does not have any physical brick and mortar locations. Okay, so they are a pure play fintech company. What products does Ally have? The checking, savings, money market, CDs. So I guess it's those are pretty similar. That's a good apples to apples comparison. PayPoint is fintech. So let's see how Ally performed. So I guess similar to SoFi, it's not really growing that much. It peaked at like 50 something and it came right back down. The reason I say this is because look at New Holdings. Well, I got it at 4.25. I just got lucky. I happen to have money and I was looking for an investment. So I think it was April 2022. I got it 4.25. I'm up by 300%. Yeah, 4.24 in June 2022. It hit 15. But maybe it's not. I thought this had a many multiple return. So from top to bottom, it's about a 300% return. And it did regress a little. It's coming back. What's it called? But SoFi, I was expecting that stock to do well. And yeah, it just doesn't look like it did. It did actually come up a good 300% from the bottom, but it's still trading below its IPO price. Maybe it was just too high of an IPO. Maybe it was just an inflated start. But the question is this a good time to pick it up? I don't know. I could see it coming back to single digits again, but it is hard to tell. You never really know with these things. But the way it's done in the past, it was from April 2022 to, so 2.5 years. It was just, it couldn't break out. It barely broke out of double digits. $11 it got up to, then came back down. So for 2.5 years, the stock really struggled. And it finally broke through that resistance up to 16. But then it came down to 12. And now it broke through a new 52-week high. So yeah, so it looks like this, but you can't sell it once it goes down. This is the kind of stock you probably have to hold for at least 2 years or so. I guess they're just not as big as Nubank. I guess that's the big difference. Because I was following both for a while, and it seemed like Nubank was smaller at one point. So that's why, or at least they were similar sizes in terms of market cap. And Nubank seemed to just take off, and it regressed a little due to market fluctuations, but it hasn't come down too much. Where yeah. But I'm still learning too, right? Own the stock but never used it. PayPoint, what's I don't know if I've ever looked at PayPoint. So that's not a publicly traded stock. Well, it's traded on the Pink Sheet. It doesn't trade on the NASDAQ or a major stock exchange. So I probably avoid it. It's a bit risky investing in OTC stocks. A lot less liquidity. Pretty small company, 600 million market cap. Yeah, I'd probably avoid. Okay. Well, thanks for joining. And yeah, I'll try to do another stream. Oh, it's British. That's why it's yeah, PLC. Yep. I see that. So it is a British stock. Yep. Thanks for joining, and I'll see you maybe in a few days or over the weekend. Okay, talk to you later.